If you know volatility is coming, then it only benefits you to broaden the basket of investments that you hold, knowing that at some time, any part of this portfolio is going to underperform. But that very well might be the part of the portfolio that is the outperformer that you need when other parts of the market are underperforming.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with Eli.
As always, happy to be here.
You always get me with the pause. Just the two of us today. So it's going to be awesome.
Mm-hmm.
It's going to be awesome. No, we've got a really good topic to talk through and then quite a few charts that I want to show the people. So if you're looking on YouTube, you'll be able to see the charts. We'll have those on there for you. But we'll just kind of jump straight into it if you're ready. So the question of the day, the topic that we want to spend most of our time on today is how do short-term market events impact long-term plans? So we've had nothing crazy, but we've had some more volatility the last few weeks. We've had, especially in individual names, you know, the indexes have held up okay-ish, but or pretty well. But a lot of volatility in some individual names. And so you start naturally getting more questions or kind of people just kind of perking up and paying attention a little bit more. So when you think of the question, you know, how do short-term market events impact long-term planning? What are some things that come to mind that, you know, people should be aware of?
Well, specifically for our listener base to this podcast, a large majority of the people who listen to this podcast are in or are nearing retirement. And short-term volatility can feel completely different when that's the case. Because if someone is young, beginning their career, similar to my circumstance, market volatility, I'm excited because I get to buy stocks at a cheaper price. Whereas when you fast forward into beginning retirement or in retirement, volatility can start to really bother you because now your income or your withdrawals are coming from this base that is going down. So volatility can be an incredibly difficult thing to navigate, but it typically, and we'll talk through this, within plans, there's not very much action that needs to be taken if the plan has been implemented properly. But you had some charts that I think are really interesting. Short-term volatility, I always liken it to, and I think this is an example that people can understand. Short-term volatility is very like real estate investing. If you buy a property, and let's say you purchase that property with debt. So you have a monthly note that you have to cover, and then you have rent that covers that note. So you may be making $500,000 a month. So in a good year, you made $12,000. Well, then there's always that 1 year where there's an HVAC repair. Yeah. And that HVAC may cost you $20,000. Well, there's a year and a half worth of expenses of your profit that just was taken back. And that's quote unquote volatility. Sure. Just the same as the stock market. So it's something to be expected in any form of investing. You just see it a little bit differently on the stock market investing. But you had some charts that I think are really interesting towards volatility.
Yeah, it's you know, a lot of these charts, this first one we'll talk through is, you know, just talking about how volatility is normal, right? Which is that can be a good thing to remind ourselves of when you see some volatility or those, you know, you start to see some names in the market move. And so, you know, this first chart talks about volatility in stocks is historically normal in all years, and it shows you the annual returns with the largest intra-year drawdowns on a yearly basis. And so it shows you, you know, what the market did in that given year, so what it ended up, but then it shows you what was the biggest drawdown in that year. And so you go back and start looking at, you know, let's just pick a year. Let's look at starting in 2015. You know, we've had so from 2015 through today, the intra-year drawdowns each and every year have been -12, -11, -3, -20, -7, -34. That was 2020. -5, -25, which was 2022. -10, -8, -19, which was in 2025. You know, last April.
Who remembers that?
Last April, you know, we saw a pretty good little sell-off, and then, you know, -3 so far this year. And so it just goes to show. And then all but 2 of those years. No, 3, because 2015 was -1%, so almost flat. 3 of those years were negative years in the market. The other 7 or 8 were all positive, and many of them positive by 15, 20 plus %. But they still had 5, 10, 15% intra-year drawdowns. So it's just a good reminder that, last year is a great example. We ended the year with a 16, 17% return in the market, but we had almost 20% pullback in the middle of the year. And if you had reacted to that outside of what your plan was designed to do and what you should have done, last year may not have been a very good year for you, right? And if you just stayed the course, you probably, depending on how you were invested, had a pretty good year. So just a good reminder that volatility is normal. Have a plan for it. Know what you should and shouldn't do when it happens, because it's going to happen. Thoughts on that?
So around the planning that comes with volatility, I think there's just a couple of planning opportunities to always be aware of in anticipation of volatility coming down the line, knowing that it's going to happen. It's going to come at some point, so we need to prepare for it and anticipate it. And another part is when it does happen, it's always nice to have a couple things in the back of your mind to know, okay, I'm going to be able to take advantage of this volatility. Even though that it's happening, I've got my plan in place, and here's a couple of things that I could potentially transact depending on the timing of that volatility and my assets.
Yeah, absolutely. So this next chart, historically normal for large down days to happen. So this is total number of 1% down days in the S&P 500. So there's around 250 trading days in the year. In 2025, there were 29 days where the S&P 500 was down more than 1%. So more than 10% of trading days, the S&P was down more than 1%, which is crazy.
That is crazy.
When you frame it like that, right? In 2024, there were 19. In 23, there were 28. In 22, there were 63. And so it's like every year, 2017 was historically low. There were only 4 days. Other than that, over the last 10, 15, 20 years, almost every year has 15 or 20 plus days that are, where the S&P 500 is down 1% or more.
With the average being
31.
31.
So that means the average year you have more than 10% of trading days. The S&P 500 is down 1% or more. I wouldn't have guessed that.
I actually would have thought it was significantly less.
When you put the 10% on it, it's that's a big number.
Well, and 1% down days are days when you pull up your investment accounts and you see 1% down, and then you see the dollar value next to it. That can be a pretty significant amount for many people, and that's never a fun day. I didn't realize it was that high on average.
Yeah, so that's super interesting. Pullbacks have historically happened in bull markets. So this is the next chart. So looking at, kind of bull market periods, different time periods, and how you have pullbacks even when you're in the middle of a bull market. So if you look at 2009 to 2020, there were 17 times, the market had a 5% pullback or more. In 2020 to 2022, so just over a couple years, we had 4 of those times. 2022 to today, we've had 7 of them, with the average being around 8 in a given bull market. Now, some of these bull markets are pretty long, right? 10, 15-year periods. Some of them are just a couple years. But again, it's saying that, this chart is showing that a 5% pullback in the middle of a bull market is very normal. It doesn't mean that the bull market's going to stop or reset. But
and it especially doesn't mean that you should react.
Yeah.
Because what this is saying is in the markets that are extremely strong, in the bull markets, that we're seeing these pullbacks. It's not in the weakest moments that we're seeing these pullbacks. It's while the market is trending upwards that we just see a little bit of price correction and we see a little bit of pullback.
And that's a good point because, where we're at today, most stocks, the most recent volatility, the market as a whole is coming off of all-time highs. It's like we're not seeing increased volatility or sell-off from a low. Right, or a not a good price. Like we're at or near all-time highs, and so seeing a little bit of pullback from there, I would say, is even more normal because of where things are currently priced. I've always loved this chart, the importance of staying fully invested. So bear with me while I try to explain this. So S&P 500 annualized returns, missing various number of days, right? So the S&P 500 annualized return. If you had stayed fully invested, this is since 1950, and this goes through the 15th, so on 2 days ago. So staying fully invested, you've averaged 8.2% from 1950. If you missed the best day
before we just passed through that, that's 8.2%, not 14,
yeah,
13, 12.
100%.
The expectations of today are that 8.2% is an underperforming asset. But this is holding stocks fully invested since 1950, and you're looking at 8.2%. So it's just a zoom out that I think we all need to understand that this period of time that we've been in has been an outperforming period, especially for U.S. stocks.
No, that's a really important piece of education for people, especially if you're newer to investing. If you're in your 20s, 30s, early 40s, maybe you haven't gone through a long stretch where you haven't not realized 10+%, annualized returns. It's good to kind of zoom out and say, and see that is better than average when you look at a longer period of time. If you've missed, so 8.2% if you stayed fully invested in the S&P 500, if you missed the best day of the year, single day, so one trading day every year, the best day, that is almost cut in half. It's 4.7. Okay. If you missed the best 5 days of the year, you've realized since 1950 a negative 4.4% return. And then if you missed the 10 best days of the year, each year since 1950, just 10 days, remember there's 250 plus trading days in a year. So you're invested for a vast majority of the time, but you missed 10 days, the 10 best days, you've averaged negative 12.2%. So what does that tell you? Returns come in chunks, right? They all come at one time. Like a lot of the year's returns are happening together in big days, right? Doesn't always happen like that, but historically, like when you look at this data, it tells you that the returns are going to kind of bunch together and there's going to be some really big days. And if you miss those days, it can be dramatic in terms of the impact it has on your long-term performance and outcomes.
And one thing that this chart doesn't do a good job of that is typically true in a stock market year is those best days come directly or pretty quickly thereafter the worst
days.
Yeah.
100%.
And so a perfect example is 2025. Market sold off 5% one day, 5% the next day. This is April that we're talking about. The next day, if I remember right, it was up somewhere around 6%.
Yeah.
So if you had gotten out of the market right after it sold off 10%, you just held off for a couple of days, then you didn't get anywhere close to the 17% return that we discussed earlier because you missed the best day and it came right after the worst days.
Yeah, and when do your emotions want to get out? It's right after the worst days because you're like, oh, this is going to continue. If I get out now, I can limit my losses, right? And that more often than not is going to lead to missing those big up days because getting back in is harder than getting out, right? So you're not going to typically get right back in. You're going to get back in after you've seen some positive movement, momentum, which is typically too late in terms of trying to make up for your losses.
One of my favorite commentators in the market, his name is Tom Lee. He runs a company called FundStrat. And there were several months ago that he was talking about V-shaped recoveries. So when the market sells off based on events that are more topical instead of the economy is actually declining, things just like the tariff scare, the market sold off pretty significantly. We didn't actually see the economy turn around, but we had a scare. He said on average, a recovery is 1.3 times the pullback. So if the market drops, it takes a month to pull back. On average, in a V-shaped recovery, it takes 1.3 months to recover back from that pullback. So if you quickly see the market decline, and it's just one of these V-shaped recoveries that ends up happening, you're going to regret having pulled out of the market in that 1.3 months that you needed to recover back to square.
Sure. Yeah. So all of this kind of tie a bow on this specific part of the conversation. Volatility is normal. Have a plan, an investment plan, but a financial plan, a cash flow plan, an income plan. Like, where are you getting money? How are you getting it? Where are you going to get it when there is volatility? Does that change how you're getting,
Is it always tied to the market or is it not?
Right. Like, have a plan for all of this and then stick to the plan. There are going to be times where, moderate, small adjustments need to be made. But you want to know that before the event happens and know what the what the expectations are when you need to make adjustments, and not react, right? Because then you're letting emotions drive your decisions, and you're acting based on how you feel in the moment versus the guidelines and the plan that you put in place before any of this started to happen. And so now you're just, hey, we're just implementing the plan as we've always planned to. So
always use the good times. So the times when the market is doing well, to make sure that your plan is in place and prepared for the bad times. Anytime that we see these good times in the market, it's a phenomenal time. We may be preemptive, but we're always going to make sure that you're prepared, or that you should always make sure that you're prepared for the bad times when the market is in the good times. It makes it much easier to take chips off the table, lower some risk, get prepared, knowing that volatility is normal, volatility happens, and sometimes it can happen for extended periods of time.
Yeah. And a lot of people, over the last 5 or 10 years, hopefully you're kind of ahead of schedule, right? Like advisors or whoever you're working with, or if you're doing this yourself, you probably didn't put the plan in place to say, hey, we're going to average 8, 10, 12, 14% a year.
In a moderate portfolio.
Yeah, depending on how you're invested. So you're probably ahead of schedule. So just have the education, the humility to say, hey, we've done well. Let's lock in some of this stuff to maybe shore up the plan moving forward in case we go through a period where it's like maybe we slightly underperform what we're wanting or needing.
And especially in retirement, I'm a huge proponent, and this is a personal, Matt, you don't have to agree with this. I'm a huge proponent to holding more cash than what most people would recommend. I think cash is a fortitude for good decisions. Cash allows you to make good decisions when times are hard. It gives you comfort when there's volatility. It doesn't earn much, so it's painful to hold on to. But what it can earn is the peace in the time when the market's volatile, and that can mean more than what the cash actually earns in and of itself.
Yeah, I completely agree in terms of whether it's cash or something else, having money that's accessible, that's not tied to the market, safe.
A reasonable amount.
Yeah. Because it's going to help you implement and keep in place the rest of the plan, which is super important. So I know you had a chart on this or some information, but this is kind of shifting topics just a little bit, but looking at kind of the best performers year to date. So we've seen some volatility, some of the bigger names, if just kind of going down the list. Let me see if I can get this pulled up. So if you look at the last month, some of the big tech names, right? I'm going to just kind of go down the list. Amazon's down 17%. Netflix is down 14%. What do we got here? NVIDIA, Alphabet, Broadcom, Qualcomm, all of these are down 7, 8, 9, 12, 14, 17%. So we've seen, and that's in the last 30 days.
Yeah.
So we've seen a little bit of a pullback in those bigger, large cap U.S. technology names. But we've started to see some other asset classes, some other sectors start to perform that have done pretty well year to date. So if you look at the best and worst performing parts of the market year to date, the asset classes, you have gold up a little under 17%. You have emerging markets up 11.7, small cap up 8.9, developed markets up 8.6, commodities up 8.2, mid caps up 7.9, real estate up almost 7, bonds up 1.4, tips up 1.4, cash slightly positive. U.S. large cap stocks, which have been kind of carrying the baton for years now, flat. So when you group them all together, they're flat because of some of those big names, selling off. Bitcoin down 21%. So, it's been we've seen volatility, but the indexes have kind of held up because you've seen other parts of the market, some new names. Walmart's a great example, local company that have kind of, at least in the short term, not saying this is like going to continue in the same way, but over the last few months kind of take the baton and say, okay, we don't mind leading the market here for a little while, and it's helped the indexes kind of hang in there.
Yeah. Rotation. We have seen this market rotate so significantly in the beginning part of this year from the story that has been created over the last 4 years. You go back to 2023, and that was the beginning of when people started to talk about the Magnificent Seven. 2023, people talked about how the market was overly concentrated in single positions that were carrying the market forward. That was increased risk. That story continued into 24. We saw a little bit of it in 2025. And what we're seeing right now is a rotation out of those companies. Matt, you just listed a bunch of companies that were a part of that Mag 7 that are now in drawdowns. But the rest of the markets, the emerging markets international, the small companies, the mid-sized companies, even companies within the S&P 500, we've seen outperformance. For example, in the S&P 500, the tech names that you just listed are negative. But if you see different sectors in the market and you look at the energy sector, up 21%, utilities up 8.7%, real estate 8.3%, industrials 12%, consumer staples, which is like Walmart, what you're referring to, 15.58%, and materials up 16.5%.
Yeah.
So you're seeing these boring parts of the market that have massively underperformed. Like if you look at the 5-year or 10-year chart, they don't look look very good.
And when that's all happened while software, if you look at IGV, software stocks are down 21% year to date, right? So you've had, Josh Brown has been talking about this over the last few weeks on their, the Compounded Friends, a podcast that we listen to, and this rotation from, if the AI disrupted companies have been getting crushed.
Mm-hmm.
So companies that people feel like are going to struggle or have to really evolve or change their business model. Maybe they, not saying the company's going to go away, but maybe margins get compressed because of AI.
Mm-hmm.
Those companies have really struggled, which is very true in the software space. A lot of these software companies are like, are we going to need them anymore? Or are they going to be able to, continue to increase prices? Or, and then the companies and the parts of the market that have done well year to date are the ones that they're not going to be disrupted by AI, right? They're your kind of picks and shovels. All of the, the consumer staples and industrials and materials and all of those names have done really well. So it's not been this, hey, we've seen a lot of money leaving the market.
Mm-hmm.
It's just we've seen a lot of money saying, hey, we don't want as much exposure to these names. We're going to go buy some of this other stuff, which is good and healthy, and
mm-hmm.
it's perfectly fine.
It's been a breath of fresh air because diversification is working.
Mm-hmm.
This is a period of time where we just came out of a time when diversification typically hurt you. We were having to explain why performance was underneath the S&P 500 because we held a diversified portfolio.
Yeah.
Now we're getting to beat our chest and scream to the rooftop saying, hey, diversification is actually helping you. Look at how much you're outperforming in the S&P 500 because we have this diversified. Well, I mean, for a long time, it was easy to say, like, well, why do we own international? Why do we own small caps? Mm-hmm.
Or why do we, you could kind of go down the list. Like, why do we not just own
S&P 500
or QQQ?
Oh, gosh, yes.
And so it is healthy, I think. And, but it's kind of exciting, to see. And
to some extent, that goes hand in hand with the conversation that we were just having. If volatility is coming, then it only benefits you to broaden the basket of investments that you hold, knowing that at some time, any part of this portfolio is going to underperform. But that very well might be the part of the portfolio that is the outperformer that you need when other parts of the market are underperforming.
Mm-hmm.
So holding a broad basket, not just purchasing one part of the market, not just purchasing stocks, not just purchasing bonds, but broadening out your exposures is incredibly important because you don't know when a rotation is going to happen and you're not going to be as quick as the hedge funds.
And like you said, this is most applicable, most important for people that are later in life, nearing retirement, in retirement, because volatility does typically matter a lot more, right? Mm-hmm. Smoothing, we've talked about sequence of return risks and mm-hmm. trying to smooth out the returns. That matters a lot more, right? And so if you're younger, buying the Qs, buying SPY could be perfectly appropriate, right? Because maybe maybe those are still the best performing or some of the best performing stocks over the next 30 and 40 years. It's just going to be it's probably going to be a pretty wild ride. Mm-hmm. And if you're in your 60s, you probably don't or can't afford to go on that wild ride. And mm-hmm. so trying to smooth out those returns by diversifying and just knowing that, hey, we may not hit the highest returns in a big year in the market, but over the long term, we should still do relatively well. And hopefully it's a little bit smoother line up and to the right. Let's hope. Any other thoughts or charts or data that you want to talk about before we kind of wrap things up today?
No, I think we've covered a good amount. It's just important if you're going to be heading into retirement. The most recent market that we have experienced is not the market expectations moving forward. You can't expect to make 12% annually in a moderate portfolio. So that's one expectation. Mm-hmm. Another is to expect volatility and plan for it. Have a plan that no matter what the market does over a 5, 7, 10-year period, your plan is going to last, and you won't be making emotional, irrational decisions just because of the market volatility.
Yeah, I was gonna try to pull up on that note. See if I could pull this up real quick. We were looking at this the other day. We use this software called Nitrogen. Helps us like manage and understand risk in a portfolio. And let me see if I can get here real quick. Okay, so just on Nitrogen, not that it's the end all be all, but it's one of the systems that we use. When you look at a moderate portfolio, very middle of the road, right in the middle of a moderate allocation, historically, like the targeted expected annual return that this system that just is using historical data gives you is a 6.2% return. Right, so that's a moderate allocation historically, and I think a lot of people today, based on what we've seen over the last 10 years, would be like, really, like that's it, And so,
you don't think that. We know that.
Yeah,
that's a consistent conversation that we're having. Is hey, 6% is a historical average when you're taking a moderate amount of risk,
and that's and none of that is about like setting that as a goal. It's just around setting expectations. So. Anyways, a really good conversation, and things to be thinking of, and having a plan before something happens. We don't want to react. We want to have a plan in place, and then implement the plan and stick to the plan, regardless of what the market's doing and what's happening. So, any other words of wisdom?
No, this is great.
Yeah. As always, be sure to check out Eli's data brief. He's got. When's your next one coming out?
It'll come out on Friday. I'm filming it tomorrow. It'll come out on Friday.
Okay.
It's talking about how most people misunderstand how taxable accounts are taxed and make bad decisions because of their misunderstanding.
Nice. I give you a plug every once in a while.
Hey. Thanks.
So be sure to check out Eli's data brief. He does an awesome job. Really good content, educational material there. Give us a like, subscribe, shoot us an email, give us a comment. We appreciate you guys, and we'll look forward to seeing you next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.